What's going on, you guys? So today we're going to be talking about whether or not GE stock is a buy right now in 2018. It is one of the most requested stocks that I get in the comment section below. People are curious as to whether or not this is a good value opportunity to scoop up some shares of GE, or if it is still a falling knife at this point in time. Now, before I get into that video, I just want to mention that the winner of my first membership giveaway for Stock Radar is Dean Thornquist. I already sent you an email. So every single week on Monday, I'm going to be giving away a free membership to Stock Radar. That's my new weekly stock analysis site where I do weekly stock analysis of a particular stock. We actually just did a full 20-minute analysis of GE stock over in Stock Radar. And I also just added a brand new course in there as well on how to read stock tables. So make sure you guys check that out if you're interested. But if you do want to enter that weekly giveaway, all of the instructions are in the description below. But first of all, let's go ahead and talk a little bit more about GE, because it's a company that a lot of people are not really familiar with as far as what this company actually is. A lot of people think of GE, they think of the light bulbs, and they think of the appliances. But oddly enough, first of all, they sold off the appliance business back in 2016, and they actually have plans to sell off the light bulb business as well. So what exactly is General Electric anymore? Well, it is basically a conglomerate of many different businesses. They're involved in all kinds of different businesses out there. They have GE Healthcare, GE Aviation, they have GE Transportation, GE Power. They have many different businesses, and they all operate under that General Electric name. So essentially what General Electric is, it's a conglomerate of different businesses and a collective research environment. So all these different businesses share research together, but there has been many problems with GE over the last couple of years, and the main problem is basically the fact that GE diversified away from their core businesses as far as their industrial businesses, and it led them to be spending a ton of money on research on things that really didn't have long-term prospects, and then they got to a point where they were in a terrible financial situation where they are just burning through cash left and right. They've been the worst performing stock on the Dow Jones Industrial Average, and over the last year, they're down over 50%. And so a lot of people are looking at this and they're saying, is this the time to scoop up shares of GE? Because it's very infrequently that you see a blue chip giant like General Electric stock fall 50%. So a lot of people are saying, is this the time to go scoop up some shares of GE? And I'm hoping to help you guys answer that question in this video today. So GE is a company that is over 125 years old. They did have a 50% dividend cut back in 2017, but they are still paying a dividend of around 3.2%. So they are an attractive dividend investment, but they are not currently turning a profit. They're not profitable right now. So odds are that if they're not able to achieve any kind of profitability in the short term, they're probably going to have to cut that dividend again, because if they don't have any earnings, how are they going to be paying these dividends? It's just putting them more into the hole. But let's go ahead and start by talking about the bad side of GE, and that's pretty much all there is to talk about right now. Everything about GE is bad news. First of all, we know they have a $31 billion pension shortfall. So they are the company with the largest pension shortfall on the S&P 500, meaning that they cannot fund the employee retirement plans. They have a $31 billion deficit as far as what they are going to be owing these employees going forward. So that's a major problem they have to solve. And this is actually a problem a lot of large companies have, due to the fact that because interest rates are so low right now, there are not many good options at all to earn a return for their pension funds. And so they're basically just sitting there stagnating while more and more people are going to be dipping into that fund. But at this point in time, there are very little options to get any kind of return from these pension funds. So that is a big problem that companies like GE and Intel and Lockheed Martin are having, is they have these underfunded pension plans. Second, we know that GE is being investigated by the Securities and Exchange Commission due to their accounting practices, and they may be restating quarterly earnings or yearly earnings, and that is not a good thing to see as an investor. We also know that Trump is proposing tariffs on imported steel and aluminum, and due to the fact that this is an industrial company, this could significantly hurt GE. And as we said in the beginning, the main problem with GE is that they are spread way too thin across too many different businesses, and they're taking major losses in certain sides of their business. Particularly, it's in GE Transportation, GE Power, and GE Oil and Gas. That's where they are seeing massive losses right now. Now, we do know that the former CEO, Jeff Immelt, was out as of last year, and the new CEO is John Flannery, and he has announced many different plans as far as what he's going to be doing to hopefully help GE. He's going to be selling off $20 billion worth of assets in the coming years. Like we said, he's going to be selling off the light bulb side of the business, the transportation side of the business. So he's selling major business assets assets. But the main criticism right now towards the CEO is that the turnaround plans are not very clear as far as what GE is going to do to get back to being profitable and get back to being a well-run company. So a lot of people are left with questions as far as, sure, okay, they're going to be selling off assets and hopefully clearing up some of their debt and restructuring the different businesses. But the question still remains, what are the long-term turnaround plans for GE? And Flannery also said that he is considering a possible breakup of the company. He says no option is being left out. And a lot of people think a company like GE should be broken up, and a lot of people would be very upset to see that. So that's kind of one where people are on both sides of the fence on that. So as we said, GE stock is down over 50% over the last year. They're trading at less than $15 a share as of making this video. And looking at all of this bad news here, why would anyone in their right mind think about scooping up shares of GE stock? I'm going to give you the main reasons right here. So first of all, we are looking at the forward PE ratio. Now, because GE is not profitable as of the most recent quarter, they don't actually have a price to earnings ratio because they're not profitable right now. They don't have any positive earnings. But their forward PE is what is very interesting to me. So GE has a forward PE of just 13.8, and if you compare that to their competitors, we see that 3M has a forward PE of 21.5. We see that United Tech has a forward PE of 18.3, and Honeywell also has a forward PE of 18.3. So in terms of their future earnings potential, GE is significantly less expensive than their peers as far as 3M, United Tech, and Honeywell go. And the other thing that is absolutely insane to me is if you look at the fact that GE did $122 billion in revenue last year in 2017. Now, they made next to nothing on that money due to their financial problems, but GE is trading right around their revenue for 2017 as far as the market capitalization. So right now, the market is valuing GE at 1 year of the revenue potential of this company, and that absolutely blows my mind. Now, of course, there are many problems. There are problems we don't have solutions to yet, and there are possibilities that GE stock could fall further. We could see this company get delisted from the Dow. We could see another dividend cut, or if the company announces a breakup, I do believe this would cause the stock to fall even further. But when you're looking at numbers like this, you got to figure how low can it go? How cheap can this stock really get? When we're at a point here where GE's market cap is almost equal to their 2017 revenue. Now, if we compare that to 3M, and do keep in mind, 3M is a very profitable company, and they're one that investors are loving right now. So they are priced up a bit right now. But understand that 3M in 2017 did $32 billion in revenue, and their market capitalization is $140 billion. So this is a company doing $32 billion, and they're priced at $140 billion as far as the market cap. And GE is a company with $122 billion in revenue, priced at $125. Those numbers just don't make sense to me, and that is why I believe that GE stock is very cheap right now. However, like I said, guys, it's been a falling knife for the last year. It could go lower, and if you are considering a position in GE stock, I would keep in mind that it could fall lower if there is more bad news about this company. Investors have very little confidence about GE stock right now, but it might be worthwhile taking a look at this if you're looking for a long-term value investment. But anyways, guys, that is all I got for this video. I hope you enjoyed it. If you're interested in entering the weekly giveaway for Stock Radar, the details are in the description below. If you're new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.